Hi and welcome to this week's Property Insider video. Today we discuss the thought that maybe the lower auction clearance rates are the beginning of the end. Is this the slowdown phase of our property cycle? Well, that's what some people are suggesting, so we'll hear what Dr. Andrew Wilson's got to say about that, as well as discussing what's happening in our rental markets with first home buyers, the fact that more investors are coming into the market, and the latest job vacancies. If you want to keep up to date with our property markets, just subscribe to this YouTube channel and click the little bell icon so that you keep up to date every time we bring out a new video. Perhaps it's a reflection of how old I am, but as I keep seeing the stories in the media about rapidly rising house prices and what's ahead for the property market, I simply think, here we go again. There are those telling us auction clearance results are a bit lower than prior to Easter, and it's the beginning of a major turn in our property markets. Others are out there telling us it's already a housing bubble and it's going to crash. Then there are those who are warning us the Reserve Bank and APRA are going to slow things down again. And of course, there's the banks. 12 months ago, they forecast 10, 15, 20% falls in property value. Now they're saying 10, 15, even 20% rises this year alone. Of course, no property cycle's the same, and I'm saying that from the perspective of investing for close to 50 years now. Over the long term, house price growth is affected by the availability and the cost of finance, by the wealth of our nation, by our population growth. But in the short term, house price growth essentially comes down to the forces of supply and demand. And each of those times it's sprinkled with a quantity of irrational exuberance, fear and greed. And boy, are we seeing a bit of that at the moment. So let's get an informed perspective of what's really going on in our housing markets at the moment, as I get the views of Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yes. Hello, Michael. I hope you had a good break over Easter. And wise words there. It is about the demand and supply interactions. But of course, we do have those emotions of fear and greed that tend to amplify that, but only over the shorter term. And we have had some interesting results on the weekend in our auction markets.
Well, yes, the auction markets were a little bit lower in the results, but is there a reason for it? So what did happen this last weekend, first of all, and what's your interpretation of what happened, Andrew?
Well, look, the results were very strong again, no surprise there. However, the Melbourne and Sydney markets did record lower clearance rates, Michael. In fact, they were both at or near the lowest rates for the year so far. Melbourne moved under 80% for the first time this year, and Sydney was the lowest since the 30th of January, just above 80%. But it is school holiday time. We need to take that into account. I'll tell you what was quite interesting, Michael. The number of listings or properties offered for auction in both Melbourne and Sydney at the weekend was one of the highest we've seen in the Easter resumption Saturday. So it was a very big number, which I think reflects that sellers are still very keen to take part in this marketplace in Melbourne and Sydney. And of course, what we did see, which would have impacted clearance rate, not just those higher listings in a holiday period, but also we do see lower, particularly in Melbourne, a lower proportion of higher priced properties in the market because they're taking school holidays and holidays over Easter. In fact, the autumn school holiday period, Michael, we always see the lowest proportion of higher priced properties, that's inner suburban properties in Melbourne, being offered for auction. So higher numbers of listings, school holiday diversions, a lower proportion of higher priced properties, which have been leading the charge in terms of auction clearance rates at the regional level. And that's all acted to push down clearance rates. But look, at the end of the day, the clearance rates are lower. They are the lowest for the year so far, but there's nothing other than those factors we mentioned there that would be deterring buyers and sellers in the marketplace. So, of course, the next few weeks will determine where we're going. But look, at the end of the day, 90% clearance rates are unsustainable, which we've seen consistently in Sydney. Melbourne's been pushing up towards the mid-80s. But certainly those Sydney numbers were always going to fall away. And if not just for the greed factor, Michael, because what happens is when you see these extraordinary clearance rates, of course, it's a disincentive to go under the hammer for sellers. They get greedy. They say, no, let's pass it in. Let's keep going. Let's keep squeezing. So there is that greed factor which can impact those clearance rates. And I think that's what we've seen. And now the other point, which was interesting, and I think this has been mentioned, that we had a higher level of withdrawals. Only in the Sydney market, Sydney withdrawals were around about 6% of listings at the weekend, Michael. And that's around about double what it's been over the past month or so. And I think, again, we may be seeing withdrawals based on vendors just wanting to take it out of the hands of the formal auction and just move into a negotiation process. Again, this is what we do see in boom markets, is that the greed factor, you mentioned fear and greed, the greed factor starts to work on the seller side of the equation, and they start to issue going to auction because they want to keep negotiating because they think that there's more upside, and perhaps there is, and we've discussed that. So I think that obviously lower clearance rates indicate a de-energizing of the market at some level and for particular reasons, but we need to watch the trend going forward. We are still in school holiday period. We are moving into the winter period gradually, and of course that is a more of a distracted market anyway. And really, we can't keep producing 90% clearance rates, Michael. As I said, the greed factor really starts to operate, and I think that's what we saw in Sydney at the weekend.
Well, what we're finding on the ground is that there are still plenty of people interested in good properties, plenty of people at auction. In Melbourne in particular, properties are selling significantly above the reserve, but we're also seeing that in our Sydney and Brisbane offices. So those people who are saying this is the beginning of the end, it's all over. Let's watch this space. But as you say, we've got to watch the trends. The other news that came out over the week is just a continuation of the good news about our economy. And one of the surprising results over this last year is how many new jobs have been created and how low the unemployment rate is compared to what some people were concerned about. And over the last week, the number of jobs ads on Seek, they showed in March it increased 10.3%, 24.3% above the pre-pandemic levels. That's a good indication of what's ahead, despite the headwinds of JobKeeper ending just a little while ago, Andrew.
Well, that's right, Michael, and that will be revealed over the next month or so. The impact of the easing of the JobKeeper allowance. We've discussed here that we don't believe it'll have a significant impact on the unemployment rate. But going forward, those are good indications that there are jobs around, that new jobs are being created. So those that do move off JobKeeper and are looking for work at least have that opportunity to find work according to that data. And I wouldn't be surprised if we continue to see lower unemployment rates going forward. It's been a great result over the past year, the post-COVID period. We've now got an unemployment rate with a 5 in front of it. And I think we're likely to remain there, all things being equal, of course, for the rest of the year. And I think that it's just been a great recovery. But of course, as we always say, Michael, there's a lot of work to do yet. There's a lot of jobs to find yet. And there's a much, much lower unemployment rate to be found as well yet going forward. But we're heading in the right direction. And our levels are certainly a lot better than just about everywhere else in the world.
Now, I know apart from tracking house prices and auction results, My Housing Market also tracks vacancy rates.
Yes.
And our housing rental markets are fragmented at the moment, aren't they? It varies a lot depending upon whether it's an inner city apartment, a high-rise tower or a home.
Yeah, we've certainly got a sort of a dual operating two-speed rental market at the moment, Michael, and even that's fragmented. It's lower vacancy rates for houses, higher vacancy rates for units. But if we look at the higher vacancy rates in units, that's really impacted by the Melbourne and Sydney inner suburban CBD markets, where there are record vacancy rates there that are pushing overall vacancy rates up. And My Housing Market is the only provider of data that separates houses and units for vacancy rates. But no surprise, of course, that we're seeing higher rents for houses as those vacancy rates fall. And we've got lower rents for units, but specifically, again, in those inner suburban areas. And really, this is Melbourne and Sydney we're speaking about. But look, I've got some hot off the press news, Michael. Just the last week or so, because we track data here on a daily basis, we are starting to see some absorption of those inner city apartments. Numbers are now moving downwards. Now, of course, it is the holiday period, and there are some seasonal reasons why we see fewer numbers up there. But sometimes in those holiday periods, we actually see higher numbers because there's fewer tenants out there looking for property. But if we compare the numbers of listings that are falling in Melbourne and Sydney for apartments for rent, actually we're not seeing the same sort of impact for house listings for rentals. They're actually still quite stable. So perhaps some early signs there, Michael, that we're starting to absorb what are still near record levels of vacant apartments in Melbourne and Sydney, but they have come down quite significantly over the last week or two, moved below 20,000 in Sydney and looking towards around 20,000 in Melbourne. As I said, still very high, but the first sign there that there is some supply is starting to ease and demand is starting to catch up now. So we may see some lower vacancy rates in those areas going forward over the next month or two.
Of course, when vacancy rates fall, and in general, when they're below 2%,
yes,
rents start to rise.
Yes.
And we're seeing that in some of the markets. There's been some good, strong rental growth, as this chart shows, not in Melbourne, but boy, Adelaide's done well. Perth's done particularly well, hasn't it? And Darwin?
Yes, look, I think there's a couple of things happening here, Michael. I think that there is the shift towards larger properties from the work from home change that we've had post or through COVID and which is continuing. Also, there's a shift to outer suburban living as well, because we don't, with that work from home, it's not just extra space, it's also not the need to have the commute into the CBD workplaces. So people are now looking for perhaps a different lifestyle in those fringe areas where there are typically higher levels of rental properties. And that's having a strong impact on rents in those areas, I guess also which had the more significant lockdown rules. But also think that we've got some migration factors happening as well, particularly in Brisbane and Perth, that are exacerbating those higher levels of rents and lower vacancy rates that we've been recording really consistently this year so far. And I think that trend will continue, Michael, particularly also as we see the top come off the first home buyer activity. I'm already seeing some early signs of that. Still quite strong first home buyer activity, but I'd be surprised if we didn't see quite a noticeable fall in first home buyer activity through the year. And of course, that'll mean first home buyers will be looking for apartments. Once, if they're priced out of the buying market, they'll be looking more towards the rental market. And so I think that that'll also have an impact on what's happening in terms of the mix of rental properties, but also on vacancy rates and higher rents as well.
Well, just confirming what you've suggested, your charts here from My Housing Market show that first home buyer activity has dropped a little bit, but it's come from a very high base, hasn't it? There was very strong first homeowner lending in the first couple of months of this year, Andrew.
Our first home buyer was both first home buyer loans and owner occupier loans fell away over February, seasonally adjusted, and coming again, as we've suggested, from very, very high levels. In fact, it's the highest level of first home buyer activity we've had since 2009, where we had that remarkable growth due to the Rudd government's first home buyer deposit boost, which brought thousands and thousands of first home buyers into the market. We're not there and won't get to that position yet, but it's certainly the second highest level since then. And owner occupiers are still at a very high level as well, Michael. But again, these things aren't sustainable. I mean, you reach a peak at those record levels and it will start to ease. But one of the other interesting points to the loan data, Michael, was that we saw again another lift in investor activity. We've seen 4 months in a row now with investor activity rising. There's been a bit of a sense that perhaps this heralds a revival. Investors need to take a cold shower on those predictions. Investor activity is still near record low levels in terms of the market share, and still around whereabouts first home buyer activity is. And we really haven't seen that before, where investor activity tracks first home buyer activity. It is rising, and that's what we would expect in a stronger market. But I still think we have significant roadblocks that are keeping investors out of the market in terms of lending restrictions. And we can still see that the difference between the average loan for an owner-occupier property versus that for an investor is still quite significant. And that is, again, reflective of the barriers that investors do face when they're trying to get a loan from the bank. And there are other barriers as well. But certainly investors' numbers are rising, but in a sense, they're rising with the rest of the market and remaining as a proportion at record low levels. And look, we need investors in the market, Michael. It's very important, not for the supply side, it's very important also for our economy. So hopefully we'll get some sense going forward in terms of those restrictive lending practices.
Well, it's not just the interest rates, as you say, it's the restrictive lending practices, the long time it takes to get a loan,
Yes.
the forensic investigation
Yes.
of what you spend on Uber Eats and things like that.
Yes.
So moving forward, there's good news coming out every week, week after week. Look forward to catching up with you again next week and seeing what happens to the auction clearance rates for the coming weekend.
Yeah, we'll be watching that one closely, Michael, won't we? See you
We will
later.
be. Thank you.